what is Bollinger Band. And by the end of this session, you should be able to understand what is the Bollinger Band is, how to add it to the chart, and how to interpret and use it. Bollinger Bands are the most often used technical analysis technique in today's market. Bollinger Bands, as the name suggests, are price bands or price channel placed on a chart to read a volatility range. A Bollinger Band is a collection of three bands drawn in a price relation. The 20-period simple moving average is the center with the upper and the lower band with two standard deviations. Bollinger Band employ a statistical measure called a standard deviation to determine where their support or resistance level are. This concept is also known as volatility channel. Based on price fluctuation, the volatility channel draws lines above and below the center line. This line is also known as envelopes, which widens or shrink according to volatility of the market. A Bollinger Band analyzes market volatility and gives great information such as trend continuation or reversal, consolidation period, possibilities of high volatility breakouts or probable market tops or bottoms, and also potential take profit levels. We'll go through the Bollinger Band indicator trading techniques in details on chart and also how to use it with combination of price action. Let's begin with placing the Bollinger Band on chart. To place the Bollinger Band on chart, there are a few methods to do it. The first method is go to Insert, then Indicators. Under the Trend, select the Bollinger Band. The second method will be the easiest one, as you click and drop it from the Navigator panel. To do that, simply go to the Navigator panel, Indicators. Under the Trend, click the Bollinger Band, drag and drop it on chart. It's done. Bollinger Band are trend indicator that detects the volatility and dynamic of the price on the market. The bands shrink when the market volatility is low and expand when the volatility increases. During the period of low volatility, the bands will be narrow, and while during the period of high volatility, the Bollinger Band expands drastically. The upper band shows a level that's statistically high or expensive. The lower band shows a statistically low or is cheap, and the Bollinger Band width correlates to the volatility of the market. From a technical point of view, trading towards the outside bands offers technical evidence of a resistance at the upper boundary and support at the lower boundary. However, this alone does not provide relevant buy or sell signals. As a result, the popular consensus is that when the price approaches the top band, it is overbought, and when the price approaches the lower band, it is oversold. The Bollinger Bands have default setting of 20 and 2. When using trading bands, we should pay close attention to the price action when it approaches the band's edges. Now, what is the standard deviation of the Bollinger Bands? The standard deviation is basically a number of expressing how much the value of the price differ from the simple moving average. Around 65% of price action is contained within the Bollinger Bands with a standard deviation of 1. 95% of price action is contained with a standard deviation of 2 of the Bollinger Bands. And almost 99% of price action is contained within a standard deviation of 3 of the Bollinger Bands. You can change the standard deviation value if you want to backtest the Bollinger Bands and fiddle with the inputs. Lowering the standard deviation will result in the price leaving the bands more frequently, potentially creating a lot of noise. However, increasing it to 3 will result in the price hardly leaves the band, making it easier to find the dynamic zone of support and resistance. Thus, Lower Bollinger Band settings will generate more trading signals, but will also increase the number of false signals. On the other hand, a 2.5 or 3 standard deviation will generate fewer but high probability signals. For myself, I prefer to trade with chances in my favor. So if a standard deviation of 3 gives me a 99% chance that the price will not exceed the Bollinger Bands, I'll be interested in trading only with these parameters. Let's look how to trade with Bollinger Bands. Bollinger Bands are used differently by different traders based on their overall trading strategy and goals. Many people use Bollinger Bands to set price targets, with some buying when the price reaches the lower band and exiting when the price reaches the moving average in the middle of the band. Others would rather sell when the price drops below the lower band or buy when the price rises over the upper band. Because traders often avoid buying when the instrument price hits the upper Bollinger Band. The upper and the lower bands can operate as a dynamic support and resistance level. Respectively, avoid selling whenever the price reaches the lower Bollinger Bands. In sideways market, when there is no clear trend direction on the chart, Bollinger Bands provides a very good support and resistance level, as most traders believe that there is high chance of prices stays within the Bollinger Bands. Bollinger Bands with a standard deviation of 3 are rarely penetrated according to studies. The price varies inside the Bollinger Bands most of the time, and it frequently returns to the center of the bands. Bollinger Bands usually appear to behave like a rubber band that can only stretch so far before snapping back to the center. Price limits are produced by the upper and the lower ranges of the Bollinger Band, which are created by the two standard deviation lines. Since there is a better chance that price will be continued within the Bollinger Band rather than penetrating it. One of the most common ways of trading with the bands is to buy on prices near the lower band and sell when price is near the upper range band, but not blindly. We talked before about price action. This strategy suited the non-trading markets when there is no clear direction. Furthermore, when the bands are parallel, the signal is considerably stronger. Thus, when the bands are parallel, we usually go short at the upper Bollinger Band and long at the lower Bollinger Band, preferably when there is additional confirmation of support and resistance. Here are few examples of Bollinger Band signals during ranges or in a sideways market. Now, let's see why traders is always advised to take the signal which based on the direction of the main trend. Just because price hit the upper or lower Bollinger Band does not necessarily mean that it is good time to sell or buy. Any trader seeking to buy at a lower price in downtrend or sell at high price in an uptrend will be wiped out by a strong trend. In fact, price will be making new highs in an uptrend and new lows in downtrend, hitting and exiting the bands, quickly taking out stops on trades taken directly on the bands. So instead, we look to sell the upper Bollinger Bands during a strong downtrend, meaning when the prices making lower lows and lower highs, and buy the lower Bollinger Bands in uptrends when the prices making higher highs and higher lows. Practically, we will look for pullback or correction, but in the direction of the trend, as we don't chase the reversal. Here are few examples of Bollinger Band signals during a trending market. The Bollinger Band Indicator, as previously mentioned, monitors market volatility. The wider the band, the higher the volatility. A narrow band indicates price movement indecision, and when this occurs, the market is almost certain to move drastically either higher or lower. Also, if the market has lately had lot of volatility and the bands are far apart, it's a hint that the market will soon settle down and trade in a range. Another Bollinger Band strategy that is relatively simple to implement is known as the squeeze strategy. Squeeze refers to the narrow of the trading range and implies a potential breakout. It happens when the price starts shifting sideways in a tight consolidation. You can visually identify when the price is consolidating as the lower and the upper band gets closer together on the chart. It means volatility of the particular instrument has decreased. After a period of consolidation, the price usually tends to make a larger move in either direction, ideally on a higher volume. Expanding volume on a breakout is a sign that the traders are expecting that the price will continue to move in the breakout direction. The longer it moves within this narrow band, or more likely the market is eventually going to penetrate these bands and continue in the direction of the breakout, especially if this event occurs in the direction of previously established longer term trend. Timing is everything, and we just don't know how long the squeeze will last. Next, we'll look into how to identify the breakout. Let's look at the Bollinger Band hooks. The upper band should be pointing up and the lower band should be pointing down. The breakout is not there yet if the bands remain flat or if one band hooks while the others don't. After a period of consolidation, a tight range, if the upper band rises while the lower band falls, this indicates that the price explosion and a price movement is about to occur in the direction of the current movement, which pushes against the band. The stronger the anticipated move, the higher the vertical. Here are some examples of valid Bollinger Bands breakouts.